Today, I'd like to chat for a minute or two about the top 5 financial mistakes we see business owners make over and over and over again. And the reason is that in our financial planning practice, we work with a lot of business owners and they just tend to make the same mistakes over and over and over and over and over again. And if we can impart anybody watching this video to cover these 5, just don't do these 5 things, you're going to, at the very least, be off to a solid start with your own personal financial planning and the long term success of your business. The first mistake we see, and the most important, I would say, is that a lot of businesses don't pay enough attention to their books and records. Doesn't matter how small or how large your business is, you have to keep track of the revenues and expenses. You have to have a consistent list of accounts with which to apply these different revenue expenses to. You could do the bookkeeping yourself. You could hire someone to do it. This is one of the early things that we delegated in my business because it made a lot of sense and made my life a lot easier. The point is that you have to have an accurate recording of the money and revenues coming into your business and the expenses going out of them so that you can make better long-term cash, financial, and business decisions. These are some of the foundational milestones that you need to know. These are some of the numbers that you just need to know in your business to make good decisions. And if you don't keep books and records that reflect what's actually going on, you're shooting in the dark. You have no way of paying attention and using that helpful data to your advantage from a decision making standpoint. The second thing that we see people screw up all the time is that they don't have any idea what their cash goals are. They don't have any cash plan with regard to cash coming into their business. And the best way to put it is that you should already know what's going to happen to the next $10,000 that comes in revenue. Are you going to use that to pay vendors or expenses or debts or take someone out for your personal compensation? How much comes out as W-2 salary versus profit distributions? There are a lot of things that you can do with cash. You should have some target for how much cash you want to keep in your business. You should know where you stand. Are you shy of it? Do you have too much? Does it need to be distributed? And then you should know in advance what's going to happen in a way that aligns with the rest of your business and personal financial planning. And we just see people treat this haphazardly where they focus on the day-to-day operations of their business, which is obviously important too, without any context or understanding of what they ultimately want to do with this long term. When you go through this planning exercise and have an idea what to do with cash before it comes in, you just follow the protocol and make it happen once it does. It makes your life far, far easier. The third mistake, semi related to that, is we see people that don't have any kind of proactive tax strategy. Here's what I mean by that. A lot of people, whether they keep good books and records or not, will get to the end of the year, they'll do some last minute cleanup of their books, they'll take all the information, and then they'll just slap it on their accountant's desk and say, "Here you go, please file my returns." That can work, but you're leaving a lot of opportunity on the table. What should be happening is you should have a proactive relationship with your tax professional to where you meet with them throughout the year, look for opportunities to pay less in tax, and design a strategy that aligns with your business objectives and your personal financial planning. You have huge opportunity to do that. And sometimes the decisions just become really clear and logical and easy when you have all those pieces lined up. But if you don't have some formal and proactive a way to meet with your professionals throughout the year, then you're just stuck reporting on transactions that have already happened as opposed to strategizing transactions in advance. And you're worse off when that happens. Now, number 4 is business owners often neglect their personal financial planning. And the mentality here is, well, I'm focused on building my business. That's where all my time and energy and effort goes into. And if I do that successfully, then my personal finances will take care of themselves because I'll have income coming in. I'll have business value that I can use to my advantage through a future sale or something else. And that is largely true. I do believe that entrepreneurship is the best way to build long-term wealth. That being said, we can't neglect our personal planning. You never want to be in a position where, on the personal side, maybe you need to replace the water heater or a car or send your kid to college, and You have no way to finance it. You have to put it on credit cards or put yourself in a tight spot professionally in order to cover those expenses. So on the personal side, just like with your business cash, you should know, what's my emergency fund target? Do my cash levels look relative to that target? Do I have too much? Do I need to invest it? Pay down debt? Do something else? Do I not have enough to where we need to take cash, reduce expenses? You need to have some proactive plan that satisfies whatever it is you want to do in your life and career long term. Because if you don't, it's very, very easy to find yourself in a tight spot that might make you force you to make business decisions that you really don't want to make otherwise. And finally, a lot of people, a lot of business owners we run into are building operating businesses that they expect to sell in the future. In reality, more than 80% of businesses never sell, and the 20% or so that do, they never go for what the seller thinks they should be worth. So, in all likelihood, you're not going to get what you want for your business when it's all said and done. It could still be a life-changing amount of money if you have substantial equity in your operation. But the point here is that you need to be investing some of your income in other companies as you go along. That could be through an index fund. It could be through buying stocks. There's a lot of great and thoughtful investment strategies that we help people employ here at the firm on a regular basis. But you need to spread your risks out, because the concept of, I'm going to build my business and then live the rest of my life off the money I get after I sell it, that is just fraught with pitfalls. And there's a very, very high likelihood that you won't get what you want for it. So along the way, use the tax code to your advantage. Open up a 401k plan, put some money in there on a tax deferred basis, take the deduction and let it grow tax deferred until you need it down the road. There are a whole lot of options for doing this. The nuts and bolts, again, should align with your personal and business financial planning and your vision for whatever it is that you want to do in your life and your career.